Good morning, everybody. Welcome to the Morning Blast. It is Monday, the 16th of February, and especially good morning to our American friends that listen up this early in the morning, particularly mine and Michael's dear friend, Nick, who we did a podcast with last night. As well, if you don't already know, this is the Morning Blast. This is where me and Mike do a very, very candid look at markets, and especially if it's Monday, it will be a look back at the end of the week, over the weekend, and a look forward for the week ahead. As usual disclaimers, nothing discussed on the podcast is trading or investment advice. No, we do not apologize for swearing or ranting, etc., etc. You take us as you find us. Michael, how are you?
Well, very good morning to you, Ryan. Good morning, everyone. It's been, 14 hours since I last spoke to you, so ready to go again.
You saw me Saturday in person and Sunday for a podcast recording and Monday morning. You are a very lucky boy.
Oh, well, I was going to say, clearly I've annoyed someone in a former life to be dealt those cards, but there we go.
Speaking of annoying, let's crack on with Clive Lambert's price updates and market levels to watch.
We love you really, Clive.
Well, obviously, as a reminder, and we will talk about this a bit later on, but as a reminder, it is a US holiday and the start of Chinese New Year. So one to bear in mind, and we will talk about that in a second. But firstly, market update from Clive Lambert, Futures Techs. Friday the 13th turned out to be a bit of a tame affair. S&P posted a doji and retook 6,845, which is the short-term Fibonacci level we've been watching for a little while. On this side of the pond, the DAX didn't see much selling to confirm Thursday's shooting stars, so probably nothing to worry about there. FTSE futures didn't retake resistance at 10,442, but again, the bulls won't be too worried. Fingers crossed on that front. Bonds saw futures gains. Bund futures trading up to resistance of 129.32 to 39, where we saw some sellers, but only some. T-notes and gilts also bid on Friday. God bless Rachel from accounts.
Oh, God.
Don't know why he's saying that. But in FX markets, things remain rather muted. For now, Eurodollar posting 3 doji candles in a row. So remember, dojis, wicks, big, long wicks, small body, a bit like myself. Bitcoin got up to 71,000 yesterday where sellers returned. 71 to 74 is now resistance. 58 to 60 is the big support zone lower down. Gold and silver, that recovered from Thursday's selling. Moving over to the oil markets, Brent WTI crude had a quiet day, or both had quiet days, so didn't follow through from Thursday's selling. Henry Hub gapped down this morning for the third Monday in a row. TTF gas, so Dutch gas, the European benchmark, has followed suit with a weak open this morning, mind the gap. EU carbon markets saw more selling down to 70 spot 55 on Friday and 69.81 this morning. Power markets, that's European power markets, continued the recent weakness. German baseload, Cal 27 trading down to the levels last seen last April. US markets basically closed this morning, obviously federal holiday due to President's Day, which we'll come on to in a bit. But yeah, that's it from Clive. Thank you, Clive.
Good stuff. Thank you, Ryan. Thank you, Clive. Yeah, as Clive quite rightly alluded to, it was a bit of a tame affair on Friday. And actually, that was kind of spurred on by the relatively tame inflation numbers that we got out of the United States. They were, of course, the main data release as the week drew to a close. Headline CPI rose by 0.2% on the month and by 2.4% on the year. That annual rate, incidentally, is the slowest rate since May of 2025. Both of those coming in 0.1% cooler than expected as well. Core inflation bang in line with expectations, rising by 0.3% on the month and by 2.5% on the year, with that annual pace of core inflation being a cycle low. We also had some relatively pleasing details of that report. Core goods inflation, which is where you'd see the bulk of any tariff-induced price pressures showing up, that rose by just 1.1% on the year, which was a 6-month low, while core services inflation, that rose by 2.9% on the year, and that is actually the slowest pace since the middle of 2021. So the US economy continuing to undergo this sort of gradual disinflationary process. It does look like the peak of that tariff-induced inflation we saw last year is behind us, providing, of course, we don't see any further changes in those tariff rates.
Go on that. I think a lot of people have been, caught with egg on their face here because there was a lot of air quotes experts telling us that inflation would continue to soar due to tariffs. And apart from that little bump in the road that we had, there really hasn't, well, on the official data, of course, I'm going to get people saying, "Oh, yeah, data's manipulated." It's not. It's just poor methodology, etc. But yeah, I think I'm surprised by the lack of inflation that we're seeing over there.
Yeah, so am I.
But
So
then
am I,
again,
I'll be completely honest.
we have seen plenty of tariff walk back. So
Yeah, I think there's a number of moving parts. I mean, obviously you've had the effective tariff rate is what, about 15% at this point overall,
something like that.
which is well off where it could have been, if you'd asked on Liberation Day, when we've got 40, 30, 40, 50% tariff rates being thrown around, which were walked back quite quickly. The other thing is not all of it has been passed on. Some has been absorbed, and there's been millions of studies done on this front, none of which I have to hand, but a chunk, it's undeniable, has been absorbed by the exporter. A chunk has been absorbed by the importer through narrower margins, essentially. Yeah. So it's not a case of, for example, the US puts in place a 15% tariff. It doesn't automatically mean that the price of that good to a consumer is going to rise by 15%. It could rise by, a third of that or half of that.
And that's what we're seeing. But this goes against what the experts, air quotes again, that no one can see, were telling us. I think it's just quite, it's insightful. I think it's just worth pointing out that, it wasn't all doom and gloom.
No, I think it's, I mean, I will happily admit I got that one wrong. I thought we'd be looking at inflation going much higher than it did and staying there for a fair bit longer. But there we go. We can't be right about everything. And we do continue to see that gradual cooling in price pressures. I don't think this materially changes things for the Fed. They are on track still to deliver further rate reductions later this year. But of course, you are dealing with inflation that is still above target. And actually, the PCE inflation metrics will be substantially higher, basically just due to how they're calculated. And of course, the labour market, Wednesday's jobs report last week is still kind of ticking along okay. Participation up, unemployment down, MFP rising 130k. So there's no urgent or imminent need, based on the data we got last week, for the Fed to be doing anything at the March meeting. Although I will caveat that again by saying that we get the February inflation and jobs data before that next FOMC discussion. In terms of other bits and bobs from Friday, of course, we reported on the show on Friday that the FT were reporting the Trump administration were considering whether they should roll back some steel and aluminium tariffs. Treasury Secretary Scott Bessent came out on Friday and he was asked about this, and he said, "We'll see if that happens. There could be clarification on some incidental objects," which sounds considerably less sort of wholesale in terms of those changes than the FT were alluding to. We then heard later in the day from trade advisor Peter Navarro, who went a little bit of a step further and said, and I quote, "There is no basis in fact that the US will reduce tariffs on metals." So I guess the FT have got that one wrong, or Peter Navarro's talking nonsense, probably both about as likely as each other, given recent form. Besides that, we also had some reporting by the SCMP, the South China Morning Post, noting that China and the US are set to secure several very positive outcomes at this leader-level summit that will take place in April, but not what they were describing as a grand bargain. Of course, as we get closer to that summit, which is probably about 6 weeks away now, these sort of stories are only going to increase in terms of their volume and their frequency. On the geopolitical front, Trump was talking about Iran on Friday. It has been, well, I don't want to use the Q word, but there haven't been much by way of fresh developments on the geopolitical situation over the weekend. Regardless, on Friday, Trump was saying that if there is a deal, then US forces will be leaving soon. Trump also saying that he thinks negotiations with Iran will be successful, but if they are unsuccessful, it will be a bad day for Iran. Not really much news, to be completely honest with you.
I'm sure I saw something where he was basically saying about the leadership really shouldn't be staying in the same place for too long. Something about like sleeping in the same bed for too long or something like that, as in keep moving around.
Oh, I must have missed that.
So a little thinly veiled, well, not so thinly veiled, but a little bit of a threat there.
Yeah, so obviously one we continue to monitor. That second US carrier strike group should arrive in the Middle East towards the back end of this week or over the weekend coming. And of course, that is only going to up the ante a little bit more in terms of whether there will actually be intervention. Just a few other headlines worth mentioning before we move on. We also heard from the Treasury Secretary, Scott Besant on Friday. He was saying that he believes that there is an agreement with Republican senators to go ahead with the nomination hearing of Kevin Warsh to be a governor of the Fed and, of course, the next Fed chair, although Senator Tom Tillis is still saying that he will not be moving forward with any Fed nominee until this Department of Justice investigation into the Fed and into Jerome Powell has been concluded. I was talking about this with someone over the weekend, and the alternative, if they do not get Kevin Warsh confirmed to the Fed, is basically Powell stays as chair. So I have every expectation that this Department of Justice investigation will be made to go away somehow, because there is absolutely no way that the Trump administration want Powell to continue for even a minute after the 15th of May when his term as chair expires. Just two more things worth mentioning here in Europe. The German finance minister was on the wires on Friday saying that Germany is looking at whether they are going to make another exemption to the debt brake, this time to boost their raw materials fund. The debt brake used to be this sort of hard limit, and over the last few years, probably half a decade or so, there's been so many exemptions to the debt brake, it looks like a piece of Swiss cheese now. There's so many holes in it, so that's not particularly surprising, but it did pressure bunds just a little bit. Obviously, if Germany are going to be issuing more debt, that is more supply of bunds coming onto the market. And lastly, we had some OPEC sources doing the rounds on Friday as well. Firstly, via Reuters, noting that OPEC Plus are, quote, leaning towards resuming output hikes from April onwards. Of course, those output hikes have been on pause throughout the first quarter of the year. Bloomberg also citing delegates noting that some OPEC Plus nations see scope to resume output hikes in April, but that they've not yet decided on those plans. Crude had a bit of a wobble on that, but recovered relatively quickly. But again, just something worth keeping on the radar.
Indeed. Thank you for that from Michael Brown. So today's topic du jour, as you know, this is our new thing, is trading on...
It's not really new anymore, is it?
Well, no, it's a few years old now, to be fair. It's basically trading around holidays and what to do on public holidays, market holidays, because obviously today is President's Day in the US, and it's also the first day of Chinese New Year, which means China's basically closed all week. So the setup is basically, as it's a federal holiday, NYSE, NASDAQ and bond markets are closed, but obviously futures are open. They reopen tomorrow, so Tuesday the 17th. The next, just for those wondering, the next US market holiday is Good Friday, 3rd of April. And in China, it's where it gets a bit tricky. Mainland China is closed until the 24th. But yeah, it reopens on the 24th.
Yeah, they're out all week.
That's a full week of no onshore Chinese trading. Hong Kong, it's a half day today, but then closed 17th to 19th of February. Singapore, again, half day today, closed 17th and 18th February. Europe's open, but what this kind of means for traders generally is obviously far less liquidity and depth of market, etc., than we'd usually expect. Now, I know firsthand there's kind of three problems with holidays, and on the psychology side of it, especially when there's nothing happening, and why it's dangerous to think, oh, there's nothing happening, is because you've got the boredom trap where traders see they see a quiet screen and start looking for action, and then you've got the whole might as well put something on. That's how holiday losses kind of start happening, and then the market gives you less opportunity and giving you worse opportunities, etc. Then of course you've got the ego problem, where some traders feel like stepping away means that they're not being serious, or they're in the wrong for stepping away when technically markets are open, because futures are open. Now this, the opposite is true. Knowing when not to trade is potentially one of the best skills you can have as a trader. And then of course, especially I think this more applies to retail traders and just like kind of part-time traders, is that I'll just check the market spiral, because you open your platform on your phone just to have a look. You see a tiny move, and because you haven't traded all day, you feel, oh, I better just put something on. The move reverses into your face on no volume, and you've actually managed to, then you've doubled down, and then, you're in a world of pain, and all you were trying to do was see what the price was. So there's a lot going on. There's a lot of ways you can lose money on a market holiday, and I'm pretty sure over the years, if you would have added up all of my P&L from market holidays, I'm guessing it'd be considerably red.
Yeah, I mean, I think there's two things at play in terms of market, actually probably three things at play in terms of market holidays. The first is exactly as you say, there is just that temptation to do something. We are all used to sitting at our desks for 10, 12, 14 hours the day with stuff going on the entire time. When you're sat at your desk and suddenly there isn't stuff going on the entire time, you almost feel an urge to make something happen. And that's when you, as you sort of rightly allude to, you end up forcing trades. You look for moves that aren't really there. You're looking for setups that aren't really there. And ultimately you end up making mistakes. So typically we would expect trade on market holidays to be relatively subdued, simply because there are not that many market participants involved. Liquidity is thin. Volumes are very, very light. Of course, that also means that if we were to get a bit of unexpected news, then you could see market reactions that are outsized compared to what we would normally expect. Yeah. And actually, we had I was thinking about this on my way to the office this morning. We actually had an example of this last month when handily President Trump decided that Martin Luther King Jr. Day would be the perfect day to start threatening people with tariffs over the issue of Greenland and who gets control of that. And of course, we did have a pretty risk-averse day because there weren't as many participants involved. Liquidity was thinner. There were fewer people seeking to fade any of the market moves that we were seeing. So it's important that, and Clive's just mentioned this on WhatsApp, and I view things the same way, market holidays are a great day to get on with all the admin that you've been putting off, clear out your email inbox, sort your personal life out, whatever it might be.
I need longer than that.
Well, yeah, you would. But I think it's also worth bearing in mind that it's also the sort of day where you can't switch off entirely. Because if we were to see, headlines break, then actually those market moves are likely to be more violent and larger than in quote unquote normal.
But I'll tell you what, though, my bar for entry on a headline would be considerably higher than normal.
Absolutely. I probably still wouldn't do it. But
and the thing is, as well, is like, when we are trading, we are looking for every edge we can take. Now, in moments of thin liquidity, such as market holidays, your stop at 100 might get filled at 97, right? So, you got to be looking at these kind of things. You got to be like trading smaller size. You got to be like increasing your stops because, slippage and all this stuff and outside, like the slippage on like stops and entries, even it's going to be something that really kind of does, knock some, pips off your profit. So again, it's like you said, it's one of those that personally, I would always look to stay off the market if I can, if I had the patience to do that. But again, that's a skill in itself. And also for the technical traders, right? And obviously this is where Clive comes in. Technical indicators become unreliable because obviously there's three pillars of technical analysis: price, volume, and time. Well, volume is being removed.
Stay there, yeah.
But no, I think it's an interesting. But also, there's obviously some great case studies about textbook examples of markets getting really carried away during market holidays, such as the yen flash crash in January 2019, Christmas Day Bitcoin flash crash. Then you had Christmas 2018 where S&P dropped like 2.7% in a shortened Christmas Eve session. So as you said, lack of liquidity, lack of participants mean that these things can get a bit carried away. I think just in terms of practicality, how you would kind of navigate a market holiday. Firstly, before coming into, especially if it's a Monday where it means basically a prolonged weekend, on a Friday, I know it's a bit late for that now, but I'd be reviewing all open positions I've got. Am I comfortable holding this not only over the weekend, which I'd normally do, but for an extra 24 hours? Widen stops or pull them entirely, because tight stops in thin markets are definitely a recipe for getting stopped out on noise rather than when a market truly reverses. Reducing the position size, check what's actually open and what's closed. It's so often you see people basically misunderstand exchange calendars. Like, I love the CME, like PIQ and CME, we've got a great relationship.
Oh my God, they need to sort that out.
However,
please.
25 years in the game, and I still can't get my head around the CME's a holiday calendar. And, and like during the holiday period, if you're not in a position, stay out. Don't open new positions just because you're bored. If you have open positions on, do obviously monitor what's going on, but be prepared to kind of just sit on your hands as much as possible and keep it simple, right? But then again, I think it's important the day after, or the market open after a holiday, the first 30, 60 minutes after the market reopens from a holiday tend to be quite volatile because you've had all that order book kind of backed up. You got accumulated orders, overnight news, over the weekend news in this case, or 3-day news, and repositioning all hitting at once. So for me personally, unless I have an edge trading a market reopen, I always kind of like to watch the dust settle and wait for that to settle before I like to get involved, because I think it always gets a bit fast market-y for that first duration, especially after a holiday session. You want to kind of wait for real money to come in and get that opening drive under the belt. But that's just me.
No, I think you're right. So the overall takeaway here for anyone newbie or experienced alike is just be very, very careful over the next 24 hours or so. And arguably, if you don't have to trade, then don't go and do something else.
At the end of the day, and I think this is kind of another great cliche for trading that I love, you don't get paid for showing up. You get paid for being right. You're not going to get rewarded just because you're sat at your desk at a market holiday when other people aren't.
Yeah, no, that's absolutely right. Cool. In terms of the week ahead, then, I think you've probably worked out by now that there isn't really a lot on the calendar for today because, of course, Asia is out, the US are out, and most people in Europe are in the mindset of, I'm not going to do anything unless I absolutely have to. So the week really starts properly tomorrow. Tomorrow brings our latest read on the UK labour market. Further slack expected to emerge. Some have been calling for unemployment to rise to new cycle highs at 5.2% in the 3 months to December, while PAYE payrolls are set to have fallen for a fifth consecutive month in January. Of course, we all know the reasons why the UK labour market is so weak, so we don't need to go into that. Also on Tuesday, we get the latest ZEW sentiment surveys from Germany, as well as Empire manufacturing data from the US and CPI figures from Canada. Moving into Wednesday, the Reserve Bank of New Zealand are set to stand pat, holding the cash rate steady at 2.25%. It is new Governor Breeman's first meeting, so that may be of some interest to folk who trade the Kiwi dollar, but it's not of enough interest to get me up at 3 a.m. to work out what's going on. Of much more interest on Wednesday morning is going to be the latest UK inflation data. Headline CPI is seen falling to 3% on an annual basis in January, down from the 3.4% that we saw in December. Core inflation also seen at 3%, while services inflation is expected to come down to 4.3% per prior 4.5%. Anything roughly in line with those expectations is probably enough to tip the balance in favour of the Bank of England delivering a rate cut at the March meeting. Quite a busy day of US releases on Wednesday as well. We get durable goods orders, housing starts, building permits and industrial production, as well as minutes from the January FOMC meeting, although as we've already alluded to this morning, the Fed are likely on hold for the time being, having adopted more of a wait-and-see approach at that January discussion. Into Thursday, we get jobs data from Australia, jobless claims figures from the United States, Eurozone consumer confidence and inflation data out of Japan. Incidentally, Japanese GDP disappointed compared to consensus expectations overnight, although that was largely down to a drag caused from inventories, which are very, very volatile, which is why markets have largely shrugged that off. Thursday also brings the most notable corporate report of the week, and that is from Walmart, who, of course, are a huge retail name in the US, so the macro impact of that could be relatively significant. And then into Friday, probably the busiest day of the week in terms of data releases, we get public borrowing data and retail sales from here in the UK. I'm just going to say now on that public borrowing data, the UK will almost certainly record a budget surplus in January. That is not because the government have suddenly discovered fiscal restraint. It's not because Rachel Reeves is a genius. It's because that's when the self-assessment tax deadline is. January is always a budget surplus here in the UK. Do not read too much into that data and do not let Labour MPs on Twitter tell you that it's a good thing. It happens every year.
I was about to say, for a fact that Rachel Reeves, Keir Starmer and your mate Tris Osborne will come out the gate celebrating that their fiscal prudence has proven everyone wrong and look at the surplus numbers.
Yeah.
Unfortunately, that's what's going to happen.
And the worrying thing is that we do know that's what's going to happen. And also the more worrying thing is people are going to bloody well believe it. But there we go. Please don't if you're a Morning Blast listener. Besides that, on Friday, we also get flash PMI figures from pretty much everywhere, retail sales from Canada. And we also get fourth quarter GDP from the United States. The economy is set to have expanded by 3% on an annualized quarter-on-quarter basis in the 3 months to December. Of course, bear in mind that about half of that period, the US government was shut down. So that's probably going to take between 1 and 1.5% off of that GDP number.
To be fair, though, it was only a very, very, very partial shutdown.
No, that one was the proper shutdown.
Oh, sorry, I thought we were on about the most recent one. Sorry.
No,
Okay,
no. This was the October, November whole government shutdown
Oh,
for
of course,
40 odd
yeah,
days
sorry.
or whatever it was.
Yeah.
So that is going to drag Q4 GDP numbers lower. It's also going to boost the Q1 GDP number when
Yeah.
we get it. And that's just mechanical because you've shut down a decent chunk of the economy. Obviously, it doesn't grow at all. You then reopen that same chunk of the economy. Statistically and mechanically, it's growing again, even though over a sort of 6-month period, there is basically no difference whatsoever.
And
so that data is going to get quite noisy.
Best example of this happening to GDP data is UK GDP with Jaguar Land Rover.
Yes.
Literally wiping out some significant, percentage points off of UK GDP because they didn't do anything for God knows how long. And then they came back and the number bounced and everyone was like, oh my God, this is an amazing GDP number. It's like, well, now we all forgetting the dire one that was before.
Yeah, there's a lot of this recently. I mean, people have always tried to spin economic data to suit whatever cause they've got, but that seems to be a problem that's getting more and more acute as time goes on. It's starting to annoy me. Besides that US GDP data on Friday, we also get the December core PCE numbers, and we get preliminary consumer sentiment stats from the University of Michigan for February as well. And of course, amid all of those scheduled events, market participants continuing to focus on any incoming headlines, whether it be trade, whether it be geopolitics, etc., etc., etc. And we'll probably get another instalment of the political soap opera in Westminster at some stage too.
Exactly that. Michael, thank you so much as always. Just a reminder, please don't feel obliged to trade on a holiday like today. Do yourself a favor, go review your trading journal for the past month or something. Do a bit of research on what you've been putting off. Do some research that you have been putting off. Read something that isn't a chart and come back tomorrow nice and fresh and clear head, etc. Or if you don't already have a trading journal, fucking start one today. There you go.
Yeah, that's a great point, actually.
Put the work in and get your trading, get a trading journal lined up, because I promise you, I don't know one person, I don't know one very, very successful trader that doesn't journal.
We were going to do that at some point.
We actually
Maybe we'll do that this week.
Yeah, actually, that's a great idea. But listeners, whatever you're doing today, please don't lose your money on a holiday. Have a great one. Hope you've all had a good weekend.